You can have iron discipline, years of experience, and flawless execution as a trader, but if you don't have an edge, you won't make the money you're looking for in the long run. Now, without this core realization in your trading journey, you'll find yourself trapped in an endless cycle of constantly switching strategies, jumping between approaches, and chasing the next holy grail that promises you overnight success. Now, the only reason I know this is because I've been trading for the past 6 years and I was in this exact cycle. But now I trade over 10 futures algorithmic strategies, meaning that they are fully automated. They take the entry and exit for me, and that's all just using code. And this is my March performance. I also have a video coming out for my April performance, so you can feel free to check that out when it comes out on the channel. Now, in this video, I want to give you the equation to trading success. It overall actually is pretty simple. It's a three-part equation. So we have edge, execution, and psychology, and that equals profitability ultimately. But each one of these carries a different weight, meaning that edge is actually the core foundation here that everything else is built upon. If you don't have edge at the beginning, none of this really matters. But what exactly is an edge? Well, there's two key forms. You've got pure inefficiency. So this is like finding $100 on the floor every Friday night after the pub. You've noticed it first, but if everyone knew about it, then that money would vanish, as everyone knows there's going to be $100 there, and also everyone would be more conscious about not leaving $100 on the floor on Friday night, for example. Now, the other example is a risk premium. So a risk premium is like spotting $100 in the middle of a highway. Others have definitely seen it too, but they haven't taken the risk to grab it. You're getting paid to be brave to get on that highway and actually pick up that $100 bill. Now, these are both explanations that I've stolen from Ewan Sinclair. He brilliantly explains it, and to sum it up, it's that inefficiency is discovering a pattern others haven't noticed yet, while a premium is getting compensated for risks others don't want to take. Now, to fully leverage your edge here and actually understand if it is a risk premium or an inefficiency, you must properly backtest this. This step is vital in the later points of our formula, and without proper testing, you're just guessing for the most part, and you won't have the conviction you need to actually execute on your edge. Now, if you want to gain the skill of backtesting, feel free to check out the first link in the description, where I kind of tell you everything I know about how to properly backtest edges and understand if it's a premium or if it's an inefficiency. Now let's get on to the next part. I want to tell you the truth about execution. Some claim that your edge is useless without perfect execution. I completely disagree with this point. When I discovered my first major inefficiency in small caps, my execution was nowhere near perfect, yet I still made reasonable profits over the years. Was it as profitable as I would be later on if I had a robot execute all of my trades myself? Absolutely not, but I was making money despite poor execution. With a solid edge, perfection isn't required to profit. However, to extract maximum value, you do need to be consistent and you do need emotionless execution. This is why now I personally use algorithms, especially when the edge is smaller or based on a risk premium, because it's actually way more important that you have very solid execution to extract that edge because it is smaller. Now, backtesting can also help you here too. It shows you how much imperfect execution costs you could have until your edge completely vanishes. Now, this could be through moving your entry parameters or moving your entry timings, or it could be just adding more slippage, for example, if you wanted a quick and easy way to see how much poor execution you could have. Now, the next part is the psychology factor. Now, once your strategy is working, psychology really enters the game here. You'll face brutal drawdowns that make you question everything. Now, I know this from experience because in some of my strategies, they've gone through drawdowns for a couple of months even, and that can be a very taxing period, especially if you have no other strategies running at that period of time. So this is really where the psychology becomes a bit more important, at least in my experience. You'll most likely have to endure losing days that feel soul-crushing, and this is where confidence and logical thinking become essential. You'll need enough data behind your decisions that going against your strategy would seem almost foolish. I think the key word here as well is foolish. What I like to do is back up my strategy so much so that it's so clear in my brain that it feels incomprehensible of why I would go against my strategy because I believe and have so much conviction in it. Now, that's only really possible if you really understand your strategy, if you've properly backtested it, and if you understand what you're trading, whether it be a risk premium or if it be an inefficiency. Now, if you're trading a risk premium, you actually don't have to be as stringent on seeing if the particular strategy is no longer working. What I'm trying to say there is that if you're trading something that's like trend following on equities markets, that risk premium has stayed true for a very long period of time. So it's quite unlikely for that to completely stop working and for you to never make money again trend following on equities. However, if you're trading something that's a pure inefficiency, let's say an arbitrage, or let's say something structural as a structural edge, then you do need to be a bit more careful to see if that strategy has actually stopped working or if that inefficiency is no longer present. Now, I wish someone had laid this out for me when I was starting out, as I was stuck for months getting absolutely nowhere. Understanding this formula, especially the premise of edge, you can dramatically increase your chances of success. The only extra part I would add to this equation would maybe be diversification if you want to scale your profits. If you want to see a video about that, it's called the Holy Grail, I believe, on my channel, and that talks about more how to use uncorrelated strategies that you can then combine and scale your profits and your risk-adjusted returns.